Testing. 1 million, 2 million, 3, okay. You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, if, particularly during bull markets. In stocks, it's so easy. You know, it's easier now than ever because you can do it online. You know, just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life, you would think a long time before every investment decision. And you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Always wanted to master the art of stock picking. Have you ever wondered how Warren Buffett, one of the greatest investors of all time, picks his winning stocks? Stick around as we break down the famous Buffett investment checklist, a step-by-step guide to selecting stocks like a pro. By the end of this video, you'll have the tools to evaluate stocks with confidence.
Play one game a little bit with me for just a minute, and then we'll get to your questions. I'd like for the moment to have you, have you pretend I've made you a great offer, and I've told you that you could pick any one of your classmates, and you now know each other probably pretty well after being here for a while. You could pick, you'd have 24 hours to think it over, and you can pick any one of your classmates, and you get 10% of their earnings for the rest of their lives. And I ask you what goes through your mind in determining which one of those you would pick. You can't pick the one with the richest father. That doesn't count. I mean, you've got to do this on merit. But you probably wouldn't pick the person that gets the highest grades in the class. I mean, there's nothing wrong with getting the highest grades in the class, but that isn't going to be the quality that sets apart a big winner from the rest of the pack.
Is the business understandable? If you can't explain what a company does in one sentence, should you really invest in it? Buffett focuses on businesses he understands. Ask yourself, what product or service does the company offer? Is it something you're familiar with or can learn about easily? Think about Coca-Cola. It's a simple business selling beverages. You can predict that people will still drink soda 5 or even 10 years from now. But tech startups in niche industries, that might be harder to grasp.
Think about who you would pick and why. And I think you'll find when you get through, you'll pick some individual. You've all got the ability. You wouldn't be here otherwise. You've all got the energy. I mean, you've got, you know, the initiative is here, the intelligence is here throughout the class. But some of you are going to be bigger winners than others. And it gets down to a bunch of qualities that, interestingly enough, are self-made. I mean, it's not how tall you are, it's not whether you can kick a football 60 yards, it's not whether you can run the 100-yard dash in 10 seconds, it's not whether you're the best-looking person in the room. It's a whole bunch of qualities that really come out of Ben Franklin or the Boy Scout code or so, whatever it may be. I mean, it's integrity, it's honesty, it's generosity, it's being willing to do more than your share, it's just all those qualities that are self-selected. And then if you look on the other side of the ledger, because there's always a catch to these, you know, free gifts and genie jokes, so you also have to, and this is the fun part, you also have to sell short one of your classmates and pay 10% of what they do. So who do you think is going to do the worst in the class? This is way more fun. And think about it again. And again, it isn't the person with the lowest grades or anything of the sort. It's the person who just doesn't shape up in the character department. I mean, we look for 3 things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity. And if they don't have the latter, the first 2 will kill you. Because if you're going to get somebody without integrity, you want them lazy and dumb. I mean, you don't want them smart and energetic. So it's that third quality, but everything about that quality is your choice. You know, you can't change the way you are wired much, but you can change a lot of what you do with that wiring. And it's the habits that you generate now on those qualities, or those negative qualities. I mean, the person who always, claims credit for things they didn't do, that always cuts corners, that you can't count on. I mean, in the end, those are habit patterns.
Is the business operating history consistent? Past behavior predicts future performance. How consistent is the company's track record? Look for companies with a stable operating history, not erratic ups and downs. Consider Apple. Over the past decade, it has consistently delivered innovative products, growing revenue steadily. Compare this to a new startup with volatile earnings. You'd be taking a bigger risk. Does the company and its industry have favorable long-term prospects? Investing isn't about today. It's about where the company is headed tomorrow. Analyze the company's future. Is the industry growing or shrinking? Are there emerging trends that could boost its success? Electric vehicles, EVs, are on the rise. Tesla benefits from long-term trends favoring green energy. On the flip side, traditional coal companies may struggle due to declining demand. Does the business have a moat? A company without a moat is like a castle without walls. It's vulnerable to attack. A moat is a competitive advantage, such as brand recognition, cost advantages, or exclusive technology. Google dominates search engines. It's hard to compete with its scale and brand. That's a strong moat. A small coffee shop competing with Starbucks? Not so much.
Only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. There can be all kinds of companies that have wonderful futures, but I don't know which ones they are. I've given talks in the past where I carry with me a 70-page, tightly printed list, and it shows 2,000 auto companies. Now, if at the start of the 20th century, you had seen what the auto was going to do to this country, the impact it would have on the lives of then your children and grandchildren and so on. It transformed the American landscape. But if those 2,000 companies, 3 basically survive, and they haven't done that well many times. So how do you pick 3 winners out of 2,000? I mean, it's not so easy to do. It's easy when you look back, but it's not so easy looking forward. So you could have been dead right on the fact that the auto industry, in fact, you probably couldn't have predicted how big an impact it would have. But you wouldn't have, if you'd bought companies across the board, you wouldn't have made any money, because the economic characteristics of that business were not easy to do. I've always said the easier thing to do is figure out who loses. And what you really should have done in 1905 or so, when you saw what was going to happen with the auto, is you should have gone short horses. There were 20 million horses in 1900, and there's about 4 million horses now. So it's easy to figure out the losers. The loser is the horse. But the winner was the auto overall.
Does the company have pricing power? If a company has to pray before raising prices, it's in trouble. Pricing power means the company can increase prices without losing customers. Apple can charge $1,000 for a phone because of its brand strength and customer loyalty. A generic laptop brand can't. Can a dummy run the business? If the business only thrives under one genius leader, what happens if they leave? Buffett prefers businesses that are simple enough to run without relying on irreplaceable talent. McDonald's is a system-based business. While great leadership helps, its model ensures continued success. Compare this to a startup driven by a single visionary founder. How much capital spending does the business require? Does the business eat up profits just to survive? Companies with high capital spending have less money to reinvest in growth or return to shareholders. Compare Netflix, which constantly spends on content, to a software company like Adobe, which sells the same product repeatedly with minimal additional costs. Who are the competitors? The battlefield matters. Who's the competition, and can this company hold its ground? Research the competitive landscape. Are they leaders or just surviving? Nike has strong competition from Adidas, but its brand dominance helps it maintain a lead. A small shoe company entering this market would face immense challenges.
Two short questions. One is, how do you find intrinsic value in a company?
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you?
Investing like Warren Buffett doesn't have to be complicated. Just stick to the checklist. By focusing on understanding the business, analyzing its financials, and identifying its competitive edge, you can make smarter, more confident investment decisions. Remember, great investing is about patience, discipline, and sticking to the fundamentals. If you're ready to start your journey, don't forget to like, share, and subscribe for more content to help you master your financial future. Let's grow together.